So today I'd like to talk about the health of the workers' compensation market in Missouri and the surrounding states and the Midwest states included. So first, the good news. The workers' compensation market remains very healthy. For a decade now, we've been posting combined ratios as an industry of about 90% on a calendar year basis. Now, the good news is that means the market's healthy, it's competitive. Missouri's a really good example of that. We have over 100 insurance groups representing 340 underwriting companies that will write workers' compensation in the state of Missouri. The market has grown from a $900 million market on a voluntary basis to over $1 billion now. So it's very healthy. That has also meant that we've seen more competition come into the state as carriers who have typically relied on personal lines insurance are now trying to diversify into lines of business that are not as exposed to catastrophic wildfires or nuclear verdicts that you're seeing in automobile. So that's the good news. Now, there are storm clouds on the horizon though, and things that bear watching. So first, inflation. Inflation has been talked about now for a couple of years. When would it show up? How would it show up? How great would it show up? Now we're starting to see the actual inflation numbers come in, and they're somewhat surprising when you dig behind them. So a good example of that is the Consumer Price Index. When you look at that, it went up 6.3%. But if you peel those numbers back, a lot of that is driven by food and fuel. And those are very volatile numbers. So how do consumers really feel about the economy? Well, you have to peel back food and fuel expenditures to look at, well, what are they spending on vacations? What are they spending on things such as going to a restaurant, taking someone out to eat? And, when you take a look at the United States, a big part of our economy is the service industry. Well, take a look at the consumer spending, and it actually went down. When that happens, service industries themselves will stop hiring workers and, in fact, may start laying them off. So payrolls will be impacted. Obviously, as a workers' compensation insurance carrier, our entire rate basis is built off of payroll. And if payroll starts to drop, premium starts to drop with it. At the same time, inflation puts pressure on medical costs. So when you begin to have that mismatch between premium growth driven by payroll and medical expenses driven by inflation, you start to put pressure on the combined ratio of the industry. That will ultimately start putting pressure on rates to have to go up. And it'll have to be watched because it will have an impact on what we end up having to charge for our product if loss costs continue to go up driven by inflation. We continue to watch these different metrics. NCCI puts out great reports weekly, monthly, quarterly that are really worth diving into. The Department of Insurance has some very good data out there on the market. So we will continue to watch all of those items and make decisions for ourselves in terms of how do we react to the pressures on our business.